Right now, someone earning $200,000 a year is quietly locked out of one of the best accounts in the entire tax code, and most of them have no idea there's a legal way back in. If your income has crossed into the six figures, the IRS has effectively told you no Roth IRA for you. Direct contributions are gone. But there's a workaround that the IRS has known about and allowed for over a decade. And it takes about an hour a year and one extra tax form, and it can move tens of thousands of dollars into a tax-free bucket over the course of your career. Now, that's where we build client account structures around exactly this kind of overlooked opportunity. I've sat across the table from business owners and executives who assume that the Roth IRA just wasn't for them anymore because of what they earned. It's almost always still is. They just never had anyone walk them through the mechanics. So here's the setup. A Roth IRA lets your money grow completely tax-free in retirement, and what that does is every qualified withdrawal then comes out tax-free as well. No exceptions, no calculations, and unlike the traditional IRA or a Roth IRA never forces money out of it during your lifetime. There's no required minimum distributions hanging over it, which means it can sit there and compound for decades. Or it can pass to the next generation while still growing tax-free. So it's about as good of a tax code item as it gets. But Congress didn't want this to be an unlimited access to that benefit, so they built in an income ceiling. Now, think about this as the tax code's version of a velvet rope. Once your income passes a certain point, the front door closes. So for 2026, if you're single or your income now is crossing over the $168,000 mark, or then if you're married and your income is crossing over the $252,000 mark, you can't contribute to a Roth IRA directly. Not partially, not at all. This ceiling catches a lot of people who don't think of themselves as ultra wealthy. A two-income household with a physician and an engineer actually clears that number without much effort. So here's the workaround, and it's simpler than people expect. There's no income limit on the contributions to a traditional IRA. And there's no income limit on converting a traditional IRA into a Roth IRA. Congress removed that limit back in 2010 and never brought it back. So the strategy is a two-step one, and it's done back to back. So let's go through that. Step one, you contribute money to a traditional IRA. You don't take a tax deduction for it, and you let it sit there at what's called after-tax basis. Step two then is within a few days, you can convert that traditional IRA into a Roth IRA. Now, since the money was never deducted, there's generally nothing left to tax on the way through. You've just funded a Roth IRA using a route that has nothing to do with your income. And most brokerages have a button just for this, literally labeled Convert to Roth. It's not some backroom maneuver, it's a standard transaction. And the IRS has explicitly acknowledged in writing. So, how much are we actually talking about here? For 2026, the contribution limit is $7,500 or $8,600 if you're 50 or older. Now, that's per person. So a married couple can each run their own backdoor Roth IRA, and they'll be doubling that number for the household. Now, it's not going to replace your entire retirement plan on its own, But done over the years or even a couple decades, growing tax-free, this really adds up to a big deal with zero tax due on the way out. And if your 401k plan allows after-tax contributions with in-plan conversions, there's a bigger version of the same idea. And it's sometimes called a mega backdoor Roth. That can move tens of thousands of dollars into the Roth space in a single year. It's beyond what we're talking about today, and it's beyond the IRA limits that we were talking about as well. So like I said, that's more advanced conversions that we've been talking about, but the underlying idea is identical, that the after-tax money is in there, converted to the Roth, growing tax-free. And with the last year's legislation locking in the lower tax rates from 2017 tax laws on a permanent basis, the environment for paying tax now at today's known rates in exchange for tax-free growth later is about stable as it's been in years. So now here's the part that trips people up. And it's the single most important thing in this entire video. The IRS doesn't let you cherry pick which dollars you're converting. If you've already had money sitting in the traditional IRA or a SEP IRA or even an old rollover from a 401k left behind years ago, the IRS treats all of that as one combined pot. So when you convert, you're not converting just your new after-tax contributions. You're converting a portion of the slice of everything you own across all of your IRA. Now, picture pouring cream into a full pot of coffee. You can't spoon out just the cream afterwards. Say you have $90,000 sitting in an old rollover IRA from pre-tax contributions, and this year you add $7,500 in new after-tax money. Say you have $90,000 sitting in an old rollover IRA from pre-tax contributions, and this year you add $7,500 as a new after-tax money. Your total IRA balance is now roughly $97,500, and about 92% of it is pre-tax money. When you convert any of it, the IRS taxes the same 92%, even though you thought you were only touching the new, already taxed money. This is where a well-intentioned backdoor Roth turns into a surprise tax bill. The fix, if this applies to you, is usually to roll those old pre-tax balances into your current employer's 401k for December 31st, if your plan allows that. That empties the traditional IRA side of the equation and clears the way for a clean, close to tax-free conversion going forward. One form ties this all together. It's called Form 8606, and it's how you prove to the IRS that you've already paid tax on this money. Miss it, and the paperwork problem can quietly turn into a real tax problem, which brings us to where people usually go wrong. So a few things that trip people up here, and all of them are avoidable. First, forgetting Form 8606. This is the single most common backdoor Roth mistake there is. If you don't file it, the IRS has no record that you already paid tax on this money, which means that the account ever gets converted or withdrawn down the road without the paper trail, it can get taxed all over again. It's one page. File it every year, you make a non-deductible contribution. Second thing that people really do forget, they even have an old pre-taxed IRA sitting somewhere, maybe a rollover from a job you left 8 years ago that you genuinely forgot that existed. That balance still counts on the December 31st value, and it triggers that pro-rata rule. So whether you remember it's there or not. Third thing here is that you'll hear people say that you need to wait a full year between the contributions and the conversions to stay safe with the IRS. Now, that caution made sense once, but concerns behind it was put to rest years ago. And people today can convert within days, specifically to avoid the account growing in value before the switch. If you're above these income limits and this is the first time you're hearing that a Roth IRA is still on the table for you, that's exactly the gap and the reason why we built our free report to have you take a look at. It walks through the Backdoor Roth process step by step, along with a short checklist to see whether the pro-rata rules apply to you before you touch even a single dollar. You can download it using the link below this video, and it's kind of a planning tool that's useful for you. Go ahead and subscribe. We put content like this out regularly, and we build around the strategies that actually move the needle for people in your income bracket. So thanks for watching, and I've hand selected this next video just for you.